Now, banks considered too big to fail face new rules on how much cash they must set aside. In addition to the 7% core capital requirement for all lenders, the biggest of them will have to hold as much as 2.5 percentage points extra. As many as 30 banks around the world could be affected by the change, including up to 8 in the US. Many banks say the restrictions will harm the global recovery. And the new capital requirements are meant to warn us which banks are the riskiest. But could they actually give some lenders an advantage in business? Poppy Trowbridge reports on how the rules could soothe competition.
Casino banking. That's what many fear sparked the financial crisis. So now, regulators want to identify the biggest gamblers. The European Banking Authority wants to group banks into separate tiers.
The biggest and most complex lenders will have to stump up even more capital against any future financial crisis.
Morgan Stanley says banks like Citigroup, HSBC or Deutsche Bank could face the highest capital requirements, having to set aside as much as 9.5% in reserves. Others, in a lower tier, would be able to set aside less. The extra capital may make banks safer, but ranking by size could also skew the competition.
There will also be undoubtedly an issue where the smaller players who are not required to have such a high premium above this 7% minimum say, well, my goodness, if Deutsche Bank's got 10%, well, we ought to get near that because we want to compete with Deutsche Bank and not being seen to be a weaker bank and a weaker counterparty.
But top-tier banks would also become the most systematically important lenders. And that could mean they're implicitly backed by governments afraid to let them fail. The concern is that means they can keep on gambling while being backed by the House. Poppy Trowbridge, Bloomberg.